anyway, we're ready to go. So one of the things we want to talk about, we like to do these education situations to make sure that everybody is on top of a lot of different things. You'll notice we do weekly webinars on market updates. We like to do these once a year. We do client education events. We want to make sure that you have the information at your fingertips to make informed decisions. We really believe that an educated client is our best client. And I'm having problems. There we go. So our agenda today, we're going to kind of go through and kind of get a feel for what we're going to kind of go through. We're going to talk about not only the economic and market update, but some proactive tax planning as well. So we want to make sure that for the end of the year, we understand what we have to worry about from a tax planning standpoint. Just as a quick refresher, here at Ashworth Wealth, we have 5 key areas that we feel are very, very important as it relates to financial planning. Those 5 key areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. We want to make sure that all of these areas are working for everyone. Everybody's at a different stage of their life. We've got clients that are in their 70s, 80s, and 90s. We've got clients in their 30s, 40s, and 50s. And want to make sure that we go through these key areas in all facets of their planning future. Today, we're going to talk primarily about some tax planning and some investment and retirement planning. We won't be going into preservation planning, but we'll kind of cover those in other areas as we do reviews. We can go over those specifically. If you're concerned about preserving certain types of assets, we can go through those as needed. This is just a recap of what happened last year. As we've met with many of you this year in the spring or the fall, you can kind of see the S&P 500 had a really, really rough year last year. Lost about 18% overall. The overall index lost about 18%. It was a very, very rough year. There's a lot because of that. People have some concerns. You can kind of see, and I'm going to kind of talk about this later in the show, but take a look at that last 3 months of the year. As bad as it was through October, the end of the year kind of ended a lot better off. And we'll kind of talk about how that typically mirrors from year to year. It's not guaranteed, but we kind of typically see that on a regular basis. But just kind of remember this slide as we get going. But last year was very, very difficult. This is why we feel it's important to maintain a certain amount of money in cash or short-term bonds, have a bond position to be able to ensure that you've got the right mix to make sure we can overcome this. Even though the market was down 18% last year, the historical average of the U.S. market over the last, let's call it 43 years, just the U.S. S&P 500 has been about 12% for the last 43 years. So a 12% annualized return for that period of time is great. Now, if you go back for 50 years, it's about 10%. So the 70s weren't quite as good as from the 80s on. But what's interesting, as bad as this may look, being down 18%, the average intra-year decline, when I say intra-year, I'm talking about the average, the low point on average during the year. So the market may end up 10% for the year in a positive direction, but during the year, it may have gone down several times, as you can see in this slide. The average intra-year decline for the last 43 years has been 13.5%. So while the U.S. stock market has averaged 12 over that period of time, we had to withstand a 13.5% negative at some point during the year. So just keep that in mind as you're looking at that and you're trying to figure out what's going on. I think the big thing is we want to make sure that as we move forward, we always recognize that there are always good times and bad times, but patience generally pays off. So as people have concerns with the market, there are several things that we want to keep an eye on. Number one is recession fears. We want to keep an eye on inflation concerns. Some people are concerns about rising interest rates. There's a lot of global unrest and possible federal government shutdowns. There's a lot of things going on right now, and a lot of that's noise. There's a term that we sometimes use, which may sound inappropriate, but I'm going to use it anyway. We call it investment pornography. There's a lot of really, really bad stuff out there that gets a lot of people really concerned. Really what it comes down to is, are companies making money? Is the economy growing? And so even though we have all these concerns, there's a lot of things that we can look to make sure that we're moving in the right direction. Now, since the end of last year, you can kind of see that the market has recovered somewhat, not completely, but we're doing a lot better. We haven't gotten right back to where we were from the prior January 1st of last year, but things are looking really, really good, even with some of these concerns. when we prepared these slides a couple of weeks ago to get in preparation for this webinar, we did not have a war going on in Israel and Gaza as we do right now. So there's always something going on. And sometimes when we look at these charts, we kind of fail to realize that markets are going up, markets are going down. There are always wars going on. There are always fears of inflation or recession. There's a lot of different things going on. We talk about recessions. We don't know for certain how long recessions are going to last, but jokingly in the office, we will many times talk about how economists have predicted 11 out of the last 4 recessions. Economists are always predicting doom and gloom. They always think, oh, this is going to be the worst thing in the world. If this happens, this is going to happen. And to be fair, war is good for the economy. As bad as war is, war generally helps spur an economic growth. Now, we're not saying that we think war is good, but when war happens, generally speaking, that means that economies are moving because there's so much money to fight. And so we'll see how this happens going forward. But right now, we're kind of just involved in a couple little conflicts here and there as from a U.S. standpoint. We'll see if that continues. But the good news is 2023 has kind of somewhat recovered. We've had a little bit of a lull these last couple of months, but we look forward to things going in the future. The question is are you a long-term investor or a short-term investor? We very rarely ever talk about short-term. Short-term investments will fluctuate based upon the whims. What's going on, in the world? Are we at war? What's going on with inflation? But long-term, everything always comes back to earnings. Are companies growing their earnings? Are they doing what they need to do to be successful? So we want to make sure that we keep a long-term focus, especially as it relates to retirement. There are short-term goals, but we want to make sure that from an investment strategy, we're primarily looking at long-term. So with some of those concerns, what we talked about, what's the direction of inflation? What are the interest rate changes? What's going on there? What are some of the recession concerns? And what's some of the geopolitical unrest? Inflation as a general rule has come back. You can kind of see from this chart, we got as high as about 8.5%, almost 9%. Many of you that are watching are taking Social Security right now. Your Social Security increase for 2023 was 8.7%. That's primarily because of what happened with inflation last year. Inflation so far this year is about 3.7%. And we just heard this week that the increase for Social Security for 2024, I believe, is going to be 3.2%, if I remember correctly. So everybody's going to get a little bit of a bump. If you're taking Social Security, be aware of that. But I do want to caution you and be careful when you listen to the media and they say, oh, inflation is under control. All that really means is it's not as bad as it was before. Because the only time I would consider inflation to being under control is if we see deflation, where the costs of goods and services actually decrease over time. That's only happened, according to this chart, a couple of times. You can see it in 2009, they went down a little bit. 2015, there was a little blip there. But for the most part, when we say inflation is under control, that just means it's not going up as fast. I think gone are the days of $2 gasoline or $1.50 gasoline. When I teach a class at Salt Lake Community College periodically and Westminster College, and I tell people that I have stamps on my wall in my office. Many of you have been in my office, and stamps on my wall, and those stamps are from the year I was born, 1970, and those stamps are 6 cents. A first-class postage stamp in 1970 was 6 cents. That's inflation. I can't even tell you what a first-class postage stamp is today. I think it's north of 60 cents a stamp now. Stamps are probably the most consistent example of what inflation does and how it damages our dollar. We don't know what stamps cost anymore because now they say forever on them. So we buy them, they last forever. I think many of us probably remember the days of buying 1 cent, 2 cent, or 3 cent stamps to be able to add to the first-class postage stamp that we had that was no longer good. So keep in mind, inflation continues to be a concern, and it's important to act accordingly from a portfolio standpoint. Now, the Fed is trying to get inflation under control. You can see what they've been doing starting in March of 2022. When it says plus 25, that means 25 basis points, which means 0.25% increase in the federal funds interest rate. So over this last year and a half, we've raised interest rates in this country by about 5.25%. So that what that has done is that's caused people to pull money, and instead of spending money or borrowing money, they put their money into a savings account or a checking account or a money market account or some kind of an account that's going to earn interest. And when we do that, that pulls money out of the market, pulls money out of circulation, which slows economic growth, which slows the pace of inflation. So this is great from a standpoint that when inflation happens, we get a higher rate of return on our short-term investments. So many of you have seen this in your portfolios. They go back there in your portfolios. You're probably getting between 3 and 4.5% on your cash accounts. You should be. If you're not, talk to your banker and try to do that. We can help you with some ideas on that as well. But make sure that you're getting compensated for the rise in interest rates. Had somebody the other day that said, I'm only getting $2.50 a year in interest on my $300,000 checking account. I said, well, you need to get that money somewhere else. Maybe look at a 3-month or a 6-month CD, or look at a money market account, et cetera, and try to get a higher return on that. And so the good news on the higher interest rates is those of you who are holding cash bonds, you're going to get a higher return or a higher dividend or coupon rate from that bond fund. Having said that, that doesn't mean that the bond funds aren't being hit from a investment standpoint because interest rates are going up. Those will start to level out as those bonds mature and they reinvest at the higher rate. You'll be able to get a higher return on investment there. Inflation does show some signs of decreasing, as we talked about, but there's still a chance that the Fed's going to raise interest rates in 2023. We would say that's probably less than 50%. We'll see what's going on. The war has got a lot of people worried about what's going on in the world. I say the war, the most recent war, but they are watching key indicators to see what they need to do to curb inflation. Having said that, once that happens, we do believe that starting sometime next year, they may need to start to reduce interest rates. It's very, very difficult right now to buy a house. I saw as I was driving in this morning, mortgage interest rates are north of 7.5%. And so it's very, very difficult to buy. So eventually that's going to start slowing down the housing market even more than it already has. So this chart just shows what the Fed funds rate has been for the last 53 years or so. And you can see that starting in 2022, they started raising those rates. There's a pretty good chance that those will probably need to decrease a little bit starting next year to kind of get those where people are actually moving as it starts to slow down the economy even more. The question is can the Fed avoid a recession? We just don't know. We'll have to wait and see how that's going to happen. As I mentioned, rising interest rates are not all bad. It just means that you're able to invest your cash and your short-term investments in a higher yielding investment. If you have any questions about that, we're happy to do that. But we just do want to make sure you understand that inflation coupled with a recession destroys our dollar. And so we have to be aware. We have to make sure that we have the money invested in the right place to make sure we can overcome the inflation. And we can't have too much invested in short-term bonds or liquid instruments like that. I mentioned a little bit about the geopolitical unrest. We've always got geopolitical unrest. We would caution you to be too concerned about it day to day. There's always reasons for people to think, oh, it's different this time. Oh, this is the end of the world. Or this time Russia's fighting this person. Or this time China's going after Taiwan. We could go back and show you a chart of the market from 1920 to today, and you could look at every time there was a war, every time there was it could go from a presidential assassination or an assassination attempt, all these geopolitical things that happen, inflation, recessions, depression, and as a general rule, the market continues to work. We truly believe that the market continues to work, but we have to be careful listening too much to the pundits, because those pundits are in the business of selling advertising. So if we spend a lot of time on CNBC or Fox Business or MSNBC, we kind of get all these pundits talking about, oh, this is how this is going to affect the market or this or that. Ultimately, in the short run, the market will be affected by geopolitical unrest. But in the long run, it all comes down to earnings. Are companies making money? Can I invest in this company? Can I invest in this mutual fund? Can I invest in this ETF? And will it grow over the next little bit because they're buying good investments and the companies are being profitable? So be very, very careful with that. Here's an example of what that looks like. This is an example on the exact same day from Business Insider. On one part of the site, they said stock market crash, recession will sink S&P 500 by 40%, an economist says. And then on the same day, another article said why the stock market could rally 25% in 12 months, Bank of America. So everybody has an opinion. And as I mentioned before, economists have predicted 11 out of the last 4 recessions. They're always predicting doom and gloom. Very few people are looking at things from a positive standpoint. But we know that in the long run, markets work. People will continue to buy Pepsi. They'll continue to travel. They'll continue to pay their mortgages. They'll continue to shop at Smith's or Kroger, wherever it is you're going, and the market will continue to grow. So be very careful about watching too much of that kind of information. Historically, the fourth quarter is the best time to invest. Now, that doesn't mean you only wait and put your money in the fourth quarter, but as a general rule, I told you earlier, we'll think back to this slide of what happened in 2022. The fourth quarter was a great recovery. So even though we've had a rough maybe August and September where the markets kind of come back a little bit, historically, the fourth quarter is the best time to be invested. So be careful about trying to time the market. Hopefully the fourth quarter this year is a good time. But as we also mentioned before, a long-term perspective is the best way to look at things. When you look at things over the long term, we're in great shape. Yes, we've had a little bit of a dip the last year or so, but in the long term, we're fine. It's always difficult when we get a new client, and right after we get a new client, the market drops. But when we look at the historical perspective, we know that we've got you positioned in the right place. We just want to make sure understand your risk level and do it accordingly, so we can take advantage of that. This is an example that I told you when I started in 1980 that the U.S. Stock market is up about 12% year over year, average return since 1980. That's with all of those downturns. Between 2000 and 2002, we had the dot-com bust. Between 2007 and 2009, we had the financial crisis. You can see a little blip in 2020 for the COVID period of time, and this period between 2022 and through the end of 2022 before it started going back up in 23 of a slight little recession going on here with the interest rate climb and what happened to the markets there. So overall, we're not too concerned about it. However, we do know that historical results are obviously no indication of future results. So we believe that the best path forward is to have caution and make sure that you understand what's going on, and we can move forward appropriately. So what we want to do is we want to make sure that we control the things that we can control as investors. What are they? Make sure you understand what your risk tolerance is. Make sure that you're not more risky than you need to be, and that you're taking enough risk to meet your needs. Make sure we know your time horizon. Most people think, oh, I want to make sure that my time horizon, my time horizon is when I'm 65. I need to change my risk tolerance. As a general rule, we want to make sure your time horizon goes about 85 or 90 or even 95, because there's a greater chance that you'll outlive your money because of inflation than because of the market going up or down. So we want to make sure we understand the time horizon. Your behavior is very, very key to this overall. Make sure we're not making incorrect decisions at the wrong time, and then your overall strategy. So these are things that you can work with. We can help you with the asset allocation. We can help make sure we get it invested the right way to make sure we're in good shape. But none of us can control the sequence of investment returns. We can't control, are we going through a recession or an expansion in the market right now? So we're going to only want to control what we can control. We can help you control the asset allocation, and you can control your behavior, your tolerance for risk, and how often you're going to need to access your money, et cetera. One of the world's famous investors is Warren Buffett. He said the most important quality for an investor is temperament, not intellect. He also said, my favorite quote by him is, he said, you never know who's swimming naked until the tide goes out. And so he's talking about make sure we have everything diversified properly, so when bad things happen, we're still protected. So we want to make sure that we do that through proper asset allocation. But temperament is so important. So a couple key takeaways from this part of the presentation. Caution is still the principal notion for investors. Inflation continues to be a catalyst for concern. Hopefully that's coming under control. Interest rates could continue to rise. We're not too concerned about it in the long run. They may go up 1 or 2 more times. Then we do believe that that'll probably start to level off. And then a recession is still a possibility. We're not quite out of the woods on that. The Fed is trying to be very careful. Can they raise interest rates slow enough, yet fast enough to slow the growth, to slow inflation without throwing us into a recession. And then long-term markets are long-term investing is still the best way to stay in the market. And if there's any questions on that, we're here to help. We can make sure we do the right thing. So that's the first piece. We're going to move into proactive tax planning for the end of the year, which is what most people want to really discuss. I think the big issue I want to understand on this is we don't want to be reactive. When you look at tax planning, tax preparation looks forward, whereas or it looks backwards, whereas tax planning looks ahead. So when you meet with your accountant or your CPA in April or March or February of next year, the time for planning is already is over. There's very few things you can do after the turn of the new year. One of them is contribute to an IRA or a Roth, or maybe contribute to a SEP. Just about everything else, it's too late. So we want to make sure in the fall that we look at and do all of the planning that we can do to make sure that we're done by the time we get to our CPA and we know what's going on. This is an example of the 7 tax rates that we still have for 2023. Now, I'm going to concentrate on the married filing joint because I'm not going to go through every single bracket. So I'm going to concentrate on that second column, married filing joint or qualifying widower. Remember that everybody has a 10% bracket. Those of you who have taxable income between $22,000 and $89,000 have a 12% bracket. Those of you who have a tax rate between $89,450 and $190,000 or so have a 22% bracket. We want to make sure that we understand how those brackets work. And before the end of the year, if you're in one bracket, we want to make sure we pretty much fill that bracket up and do as much tax planning as possible. So in our fall reviews, we've been going through this to make sure we're on top of some things. So take a look at where you are. If you're single, look at your bracket. If you're married filing separate or a head of household, look at your bracket and find out where you are. Now, currently, these are going to phase out in 2026, and I'm going to show you a slide here in a few minutes that shows what that's going to look like, but understand what the tax brackets are. One of the best things we can provide you as an advisor is Tax Alpha, and where we can go through and make sure we minimize your taxes. So we'll talk about some strategies. Understand that the standard deduction amounts for 2020 for 2023 are as such. If you're married filing joint, it's $27,700. So we want to make sure you understand, should I be itemizing this year? Should I be taking the standard deduction? Does it make sense for me to bunch my charitable contributions? Those of you who are making annual charitable contributions, take a look at those year to year and say, should I bunch those together and do double this year or double next year and take the standard deduction? We only have about 3 more tax years for these standard deductions being this high. Those are going to sunset in 2026 if Congress doesn't act as well. So make sure you're looking at these. Talk to us if you have any questions on that. So the old rule on itemized deductions was to accelerate the deduction, but the new rule now is to plan your deductions. So as I mentioned, do I bunch my deductions this year? Do I bunch my deductions next year? Now, some of you may not make any sense. It may not matter what year you do it. You may be taking the standard deduction. Some of you may say, well, it's about the same. So the main thing is from a tax planning standpoint, we want to make sure that we're doing the right thing, that we're taking advantage of getting the most deductions that we can. I can assure you there's not a charity or a church or a football program out there, whoever you like to donate money to, that cares what year they get their money. If you give it to them on January 2nd instead of December 31st because you want to make that deduction double next year, they're not going to care. If you want to accelerate it this year and do nothing next year, they'll be very happy to take the money whenever you're willing to give it to them. So we want to make sure we do that properly. But it's important to understand how this affects you from a tax standpoint. Capital gains tax rates for 2023 are as such. I told you I'm going to go through the married filing jointly. So many of you are living primarily on capital gains. If you can keep your taxable income after your standard deduction below $90,000, you'll pay 0 taxes this year. So some of the things we can do on capital gains, we can defer other types of income and take capital gains for this year. You can pay very, very little taxes or no tax if you do that appropriately. This also goes true if you don't have a lot of income this year, you can actually harvest capital gains during a year and pay 0 taxes. Or if you're in a higher tax bracket, we might be able to look in your portfolio and harvest some tax losses. Now, anytime we talk about tax losses, people get really concerned and confused. Like, why in the world would I harvest tax losses? Well, we look at it a little bit different. A loss in your portfolio, while temporary, may be good to be able to ensure that you're able to take some tax losses against ordinary income. So some things that we can do. We can sell assets to offset capital gains, and you can even use an additional $3,000 of capital losses to offset ordinary income. So we have to be very, very careful how we look at this. But there's nothing wrong with going and looking at your portfolio and selling things at a gain or selling things at a loss from a tax standpoint. So we want to look at that before the end of the year. Many of you, we've already talked to you about this year. Want to make sure we're on top of that. Now, if most of your money is in 401ks or IRAs, this does not apply. We're talking about an after-tax account, a taxable account where you actually we have to watch capital gains and losses on an annual basis. A couple things. So those of you who are still working, before the end of the year, make sure you understand what the contribution plan limits are for 2023. If you're contributing to an IRA and you're under the age of 50, that number is $6,500. If you're over 50, you can do $7,500 for 2023. The 401k deferral is $22,500. That's the max. Unless you're over 50, then you get an additional $7,500. If you're contributing to a simple IRA, that number is $15,500 with a catch-up of $3,500. You can see these others here. So make sure that you understand where you are. Are you contributing the maximum that you can if that's what you're trying to do? We always recommend you at least contribute to what the match is, and then make sure we go forward. But make sure you look at before the end of the year that you don't miss out on doing those contributions. We also want to explore the Roth IRA conversion benefits before the end of the year. It can lower your overall taxable income over the long term. We get tax-free compounding, and there's no requirement minimum distribution. So many of you, we've already talked to you about this. If you have not filled up one of your tax brackets for the year, if you're in the 12% bracket, for sure, we want to explore the idea of converting your Roth or your IRA to a Roth IRA before the end of the year. If you've got $10,000 of remaining taxable income in that 12% bracket, we want to make sure that we take advantage of that. Sometimes we'll look at this and we'll say, hey, how do we do this from a standpoint of within the family? And so we want to make sure that as we those of you who are getting closer to retirement, or excuse me, closer to, I went too far. Hang on, my computer froze up for a second. Those of you who are getting closer to, you're already in retirement, you're getting closer to leaving money to your heirs, we want to look at your tax planning from a standpoint of, can I make sure that I'm doing this from a tax standpoint for my heirs? Now, the number one concern that we have is you and your money. We primarily are concerned about you. If you believe that you've got way too much money and you want to make sure that you leave that to your heirs in the most tax efficient manner, the best way to do that is to look at your tax bracket and their tax bracket. Now, we're not suggesting that you give money away now if you're not ready to do that. We're just saying that sometimes we want to look at the family tax bracket to make sure we understand what's going on. We have several people we work with now that are looking at this saying, hey, I'm in my 80s or my 90s. I'm never going to spend this money. I'm not spending any money right now. I want to convert my IRA to a Roth now, pay the taxes as low as possible because my children are very successful and they'll pay less tax when they inherit that money. That's an option that we have. So just keep that in mind. We want to not just look at your tax bracket, but the family tax bracket. As we look forward for tax estate planning for 2023, those of you who are making annual exclusions to family members and giving money away, that number is still $17,000 for the year. Keep in mind, you can give away more than $17,000 per year if your spouse is involved in the gift. That makes it $34,000. And if you want to give to your children and their spouse, you can double that to $68,000. Some people are doing this because they've got a lot of money. They want to make sure they give money away while they're alive so their kids can enjoy it rather than wait until they die. But understand that you're not limited just to the $17,000. If you can make money directly for medical bills or education for a child or a grandchild, and it can go above the $17,000 exemption. I won't spend a lot of time on this slide. This is just the federal estate tax exemption for 2023 is just under $13 million. So we don't have a major concern with what's going on with many of you from an estate planning standpoint. Only estates worth more than $26 million right now are going to be taxed. The concern we have is in 2026, that's going to drop in half. It's going to go to about $6 or $6.5 million. I just want to keep an eye on that as we do wealth planning, wealth transfer planning as we go forward. So for now, we're not too concerned about that. We want to make sure that you're aware that that's going to sunset as well. We have like this little window between now and December 31st, 2025, where the tax things are going to change a little bit if Congress doesn't act. A quick reminder about qualified charitable distributions. Those of you who are making charitable contributions each year, if you're 70 and a half or older, you're able to take that money directly from your IRA. This must come from an IRA. You can't do it from a 401k, but you can donate money directly from your IRA to a charity, and it meets your required minimum distributions if you're of the age of being able to take that. So even though RMDs are not starting until 73 for most people now, and if you're born after 1960, you actually don't have to start taking your RMD until you're 75 now. Once you hit 70 and a half, you can make a tax-free contribution directly from your IRA to your 501c3, your church, your charity, whatever you're trying to do. We want to make sure that you understand that. Now, the downside to that is you don't get to take the tax deduction. If you're contributing money directly from your IRA to a charity or your church, you do not get a tax deduction. It doesn't show up on your Schedule A as an itemized deduction. So we want to make sure we marry that strategy with the bunching of strategies and utilizing your standard deduction accordingly. So just be aware of that. I had a client years ago that said, hey, I'm going to do this. This is great. And then he was frustrated that he didn't get a tax deduction. And I said, well, you really don't get a tax deduction when the money is not yours. Money in an IRA is not your money yet because you have not paid taxes on it. So, but understand that we can do that. We can give it directly to the charity, et cetera, and not have to pay taxes on that money. So as we look ahead, here's some things that are going to change in 2026. The income tax rates are going to change. I'm going to show you that table here in a second. It's very ugly. I'll warn you. The estate tax levels, which we talked about, they're about $12–13 million right now. They're going to be cut into half. That's the estate tax exclusion. The SALT cap is going to disappear. SALT stands for state and local taxes. So those of you who are itemizing your deductions on your Schedule A of your tax return, you get to deduct your state and local tax. For most people, that's your property taxes for your home and your state income taxes. Right now, that is capped at $10,000. So if you pay more than $10,000 combined between property taxes and state income taxes, let's say you pay $15,000 a year, you only get a deduction for $10,000. That's going to disappear. So you'll be able to take the full deduction. So 10,000 is a cap now. In 2026, that'll be a benefit. You'll be able to take a little higher deduction there. But the standard deduction is also going to drop in half. So that 27,700 figure we talked about for 2023 is going to get cut in half. But on top of that, there'll be some other things that'll happen, such as the personal exemption will come back. So there's a lot of things in flux. We will keep an eye on this for you as your advisor and make sure we're on top of those things. But we want to make sure that we're looking at each of these things to keep you on top of things so we can make sure from a tax standpoint. 2024 and 2025 will be major tax years to make sure that we're on top of some things. This is a chart that will show you what is going to happen in 2026 and beyond. If you look closely, you can see the tax rates in 2016, 2017. They were 15, 25, 28. Well, there's a 10% down there at the very bottom. 10%, 15%, 25, 28, 33, 35, and 39.6. Those went away for a period of time. But what I really want you to look at is the size of the blocks inside those tax years. In 2018, you can see that the brackets went to 10, 12, 22, 24, 32, 35, and 37. Okay. Those are now going to sunset. And notice in 2026, how far down the 35% bracket goes and when the 39.6% bracket starts. That 39.6% bracket starts at 600,000. People say, well, that doesn't affect me. Okay, well, great. Well, let's go down to the brackets that were at 22% are now going to be at 25%. The brackets were at 12% are now going to be 15%. But look what happens. Those of you who are in those brackets are going to pay more taxes starting in 2026. And the 28% bracket stops at 300,000. Every once in a while, we'll have somebody that will come in, they'll say, hey, I want to do a $200,000 Roth conversion this year. I'll pay my taxes right now and I never have to pay taxes again. Well, those kinds of strategies may go away. We'll probably be back to just doing very, very small Roth conversions, but we do have a couple more years before those brackets change. So just be aware of that. Look at where you are at your income level. If you're at $100,000 income level, you can kind of see you're going to be kind of at the top of that 15% bracket. Just be aware of that. Just remember that we want to stay proactive. We want to make sure that we're looking forward and not just backwards in tax planning. Understanding what those brackets look like in the future will help us do tax planning today. If it makes sense to save 3% taxes, do a Roth conversion now in 2023 or 2024, we will do that. So we want to make sure that we do that accordingly. We want to keep you updated to tax laws. We don't do tax preparation at Ashworth Wealth. We do tax planning. We want to make sure that we do that properly. So when you meet with your CPA, your accountant, do your taxes, everything is already in order and we can go from there. So in conclusion, what can you expect from us? We're going to do a regular review of your changes that may affect you. We'll do some regular communications. Hopefully you're getting our weekly webinar in email, the market updates that we do. We have the monthly newsletter that comes out. We continue to do client events, education events, some fun events as well. We'll always want to make sure that we're reviewing your economic, tax, and estate situations and make sure we're doing that properly. We do have an estate planning attorney that's in the office every Thursday that can answer questions as well. So if you're interested in doing that, let us know. If you want somebody to review your trust, review your will, make sure you're on top of some things, or just get that going for a regular basis. He comes in every Thursday, which makes it easier for people to be able to have that. So Austin, any questions that you want to, any chat questions? If you have any questions, throw those in the chat really quick. I'll give it a couple of seconds. We do appreciate you coming. We want to make sure that as we move forward, we do appreciate everything that each of you do for us. We hope we're providing the best advice and best planning possible. If you have a friend, you want to add them to our mailing list, let us know. You want to invite a guest to a workshop or webinar, let us know. If you want to encourage somebody to come in and schedule a complimentary financial checkup, let us know. We're more than happy to help in any way possible. Keep us posted. Remember, this has been recorded. You can go back and watch this again. And if you have any questions, number one, and number two, feel free to forward it to any friends or family members that you have that you think will be interested in hearing some of the market updates as well as some of the tax planning things that are going in the future. I look forward to seeing you guys soon, and we'll go from there. Thank you.